Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon. And today we're going to have a weekly strategy roundtable where we talk about current market conditions and any questions you might have about your subscription, what to expect in the market short-term, long-term, and where are the opportunities in the market, what strategies work, what do not work in this environment, and some of the sectors that might be beneficiary. Before we begin, this is my brief bio. I want to say welcome to everybody. If you're new to Tradespoon, please type in first. Always want to welcome new subscribers. This is my bio. My background is technology. I have a master's degree in computer science. I've been the CTO of several financial startups here in Chicago. Started Tradespoon over 10 years ago. Very proud of that experience. Kind of helps me combine my passions in technology, building models. I have master's emphasizing artificial intelligence. So we have a team of financial engineers that have PhD in physics and mathematics, and that are constantly building new models using new technology and advances in artificial intelligence, and also managing my own money and trading. Anyone is new? Most of you guys have familiar names. Some of you are not familiar, but okay. Say hi on the chat. Just type in hi if this is your first event. Disclosures are very important. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risks and willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, it should not be assumed that the future trade picks will be profitable or will equal past performance. All right, in terms of trading plan, before we jump there, let's look at the current market conditions, right? Earnings season kind of started right this week. Well, before we get into the earnings system, the most important, I think, is inflation data, right? Inflation data. We had CPI data and PPI data this week, and we have geopolitical risks, right? Unfortunate situation that's happening in Middle East, right? In Israel. You know, my prayers and thoughts go out to all the civilians that are suffering from this unfortunate disaster. So on top of the geopolitical news and inflation data, we have pretty sharp pullback, right? We have pretty significant rally in yield, right? From the beginning of, well, actually from July, where the sell-off started. Kind of a steep move in interest rate, right? Higher for longer. From 3.7 to 4.8, right? Adjusting to this 1% higher target of interest rate by end of the year. And now it looks like it's losing momentum. It pulled back, market rallied, right? Yesterday it had a pretty big reversal and a little bit worse than expected CPI and PPI data. And now that the earnings season started, at least as of right now, we pulled back in the yield, right? Going through this consolidation. So the most important yield, right? The question is this the top, right? Is this the top? And we're very close to the bottom in this market pullback, and the next leg is up, right? Or is the yield going to continue going higher, right? That's kind of the question, and how far, right? So that's the most important question. I don't think even the earnings are going to matter that much to change that picture. You can see today, even though we had a pretty good earnings from the banks, right? For now, market's not reacting, you know, across the board, right? The regional banks are actually lower. Banks are up 0.8%. We have JP Morgan up 3%, Citigroup up 2%, Wells Fargo up almost 4%. So pretty sharp rally on better than expected earnings from banks. But it's not lifting the entire market, right? For now, SPDR is flat and QQQ is actually slightly negative. So, and then the next most important variable is the dollar, right? Dollar continues to be strong, actually follow through yesterday's round. Very similar price pattern to yield, right? I think they're pretty highly correlated. We have a strong rally from July in a dollar on a higher yield. Pull back, we had a rally in the market, and now we have 2 days of this sharp rally in the dollar, which is, putting pressure on the rest of the market. So the question is, what's the next move in the spiders, right? There's two scenarios, right? Early season is better than expected, right? This is a pretty significant test for no landing, soft landing narrative, right? The idea of soft landing and no landing narrative is that everybody's employed, everybody's spending money, and companies are making money. JP Morgan came out, they keep raising their income from the interest rates payment and from the additional business, and same thing was Citigroup and Wells Fargo. So if that's going to be the message across the board, then the next move is try to reclaim year-to-date high, right? So that's scenario number one, right? This is the bottom, right? And we might pull back maybe a little bit further, but we're heading higher, right? That's scenario number one. If earnings is better than expected, geopolitical risks are contained, and there is no runaway in yield. The second scenario, yields 4.8 is not high. We get to 5, maybe even 5.5, right? And dollar continues to rally, and either the earnings are not as good as everybody expected, right? Or we have a sharp rally in the dollar. Continue, not sharp rally, but continue rally in yield in the dollar. Scenario number two. And we retest 200-day moving average, maybe even based on exactly what happens, maybe even overshoot. So those are the two scenarios, and very important to kind of consider both scenarios, right? If you've been bullish this year, you're probably gonna, continue to say one, right? I mean, this is just a healthy, 8 to 10% pullback happens in every bull market, right? And you're still one, but you should consider at least two to determine position size, right? My favorite book lately been Thinking Fast, Thinking Slow. If you've been in live trading room, I review this, and it's very important, to kind of understand prospect theory, right? To understand prospect theory and risk aversion, that it's not just you and I. This is how we are wired, right? On DNA level, this is how we wired. When we look at the gains and we have a chance to lock in our gains, we would always take smaller amount. And every time we are faced with losses, and if there is any chance, right, and we're trading in a market which is uncertain, every time we have losses, we always think that we're risk averse. We don't want to we don't want to close the position right now, because we're always hoping, we want to avoid this risk, and we're hoping that trade will go in our direction. So it's not something that I do or just you do. It's been proven in a lot of experiments in psychology. Prospect theory, I think, is well accepted theory, is that it's just how we are wired, right? We have risk aversion and skewed perception of, when it comes to risk taking, taking profits and taking losses. So how do you approach these situations, right? The book basically says, well, you need to go through these positive and negative rehearsal exercises, kind of envision market being at 460, envision the market being, 420, right? Maybe to 15, 20 points lower, maybe 15, 20 points higher, and determine this position size, right? And again, the reference point in prospect theory, because, if you have $10,000 account and 2.5% loss, right, that's $250. But if you have $100,000, right, 2.5% loss might feel different, right? Just based on your background, how much money, money you have in your savings account. So everybody's different, right? It's not like a universal law. So you do have to consider a reference point, but general rule, I think, whether you manage in 100,000, a million, or $10,000 or $500, if you're down 1%, it's okay, right? Per position, right? 1% to 2%. If you're down 5 to 10%, doesn't matter if you manage in 100,000 or 10,000. It's becoming, that's where you have that fight or flight response. So you want to make sure that if you're bullish on the market and you said 2, right, that, if the trade goes against you, and let's say we do revisit 420, this is an opportunity, maybe a great opportunity to go long, right, or add to your position. But it can only happen if you're down less than 2.5%. So these rehearsal exercises are very important. I encourage you to do them. Bob present. So how many of you say 1, we're heading higher, earnings season is going to be great? Seasonality perspective, we're in the middle of October. We're heading into November, where everybody feels good. Christmas, Thanksgiving, everybody's in good mood. Earnings are going to be great, and we're 1, right? Window dressing by all the fund managers that been missed this rally from October. So that's 1, right? We're heading higher, and 2. If you basically think that we will retest 200-day moving average and maybe break it, right? Because of maybe earnings are not as good as everybody expected, or maybe because higher for longer and this inflation data is pretty stubborn. The headline news on Twitter, Wall Street Journal, is that the new norm is 3% inflation. We're not going to get to 2% by end of the next year. Right, so if that actually is a true statement and the Fed doesn't change their rhetoric, we're going to have again this idea that maybe it's 10 years shouldn't be 5%, maybe it should be 5.5%, maybe it should be 6%, right? And that puts pressure on the market, right? Higher for longer, high interest rate environment, that's going to be putting pressure on the market. So that's the reasoning for 2, right? So how many of you say 1? How many of you say 2? Let's go over those numbers. 2, Martin, 2, Bob. Okay, pullback, higher, low, 2. Anybody 1? Michael, 1. Okay, we have some. Martin, Bob, Michael, thank you. Okay, so half of you said 1, half of you say 2. I'm going to go with 2. I do think we're going to revisit the lows, maybe even break them marginally. Potentially this is, I think, worst case scenario. This is probably core scenario. Core scenario, we revisit 420 based on geopolitical news and earnings, etc. We might revisit, get as low as 404. But I do agree after, maybe middle of November, right? Maybe middle of November, as we have more clarity from, Tesla and Apple and Microsoft and Nvidia, then we do head higher. But I still think it's going to be a low, I don't think we're going to break through this level, right? First half, right? First half of next year. I still think we're trading in the bear market, right? That now the new channel is this. This is kind of the new channel we are trading in. But again, a lot of it depends on the earnings season. A lot of it depends whether the 420 will hold. If 420 holds, then I'll have to adjust. We'll probably revisit the highs. If the 420 doesn't hold, I think then I think it's going to be a pretty sharp pattern of lower highs and lower lows. So a lot of it depends if we're going to revisit 420, and when we revisit 420, will it hold, right? For now, it's too early to tell. In terms of next trigger in the market could be, we have retail data on Tuesday. Usually it comes in within expectations, right? We do have Fed beige book, which has been negative. Retail has been strong, better than expected. So retail might give positive boost to the stock market. Beige book leading indicators have been negative, right? That might be, again, higher for longer. And then, so in the next couple of weeks, I think mostly it's going to be geopolitical risks and earnings, right? Earnings. All right, any questions? And I would watch also the earnings stories, right? Like so far, every time there has been good earnings, right, from companies, initial reaction like Delta Airline, it rallies, and then it continues the sell-off, right? Pepsi is a similar example. Better than expected earnings, rally, and now selling off, right? So I would watch the earnings reaction just to see, is the earnings narrative enough to overcome interest rates, inflation fears, recession fears? For now, Delta Airlines, Pepsi has not. Walgreens, Buddha Lines, for now, is holding most of its gains, right? But it's been kind of sold off precipitously. So now the question, JP Morgan, is JP Morgan going to continue to rally? Like we started the session at 153, we're now at 150, where are we going to end, right? If we're going to close at 140, close to 148, that's going to be negative. If we're going to close at 154, okay, that's going to be positive. So that's kind of very important. A data point to consider, right? And so far, JP Morgan pulled back. I mean, probably, give up more than half of its gains. Citigroup gave up more than half of its gains. Wells Fargo, still keeping half of its gains, and UNH also gave up, more than half of the session gains. So I would keep an eye on these earnings and how the stocks react, next week to these earnings. And IPO, I would look at IPO, right? Instacart, everybody was highly anticipated earnings. IPO price around 30, jumped to 43, and now dropping, precipitously way below the price. And in technology, arm holding, right? IPO at, I think it's around $50. Was as high as $670, and now I think trading either below or at near the IPO price, and sitting on this support, which I would also hold. I would keep an eye on. All right. Any questions in terms of what to expect? Michael and J1, thank you. Consumer sentiment seems to be hurting the market today. Came in weak. Thank you for sharing. So consumer sentiment. I mean, yeah, so the market is going to react to these macro and microeconomic news, but a lot of it, mostly it has to do with technical trading, right? Mostly it has to do with technical trading. When it's a 200-day moving average, it's oversold, right? Doesn't matter what's the, technical indicators you're going to use, RSI, MACDs, chart patterns, it's oversold, right? When it drops 8 to 10% in straight line, usually it's oversold. So you do have a bounce back to 50-day moving average. That's already working off most of the negativity, right? And now it's rolling over and retesting this important line, right? We've talked about these lines in the sand at 444. Now it's 432. If it drops, if we close today below 432, I would maybe consider, not today, I would wait tomorrow, right? But let's say we're trading below 430 on Monday, I would consider maybe, again, close some of your long positions, maybe add on to your short position. In this market, right, we've been trading in a sideways market, right? If I go back do monthly chart, right? And I basically say what happened since June of 21, right? So for the past 2.5 years, right, we basically flat, right? We were higher, we were lower, we were higher, we were lower. So, and this pattern with interest rates, especially if we're not going to achieve 2% interest rates, right? This concept of higher for longer, and we will or will not have some kind of recession, this could continue for the next 6 months, it could continue for the next 18 months, right? Nobody knows exactly, right? So if this is the pattern, right, if we're going to say that this is going to be the pattern for the next few years, not few years, but probably not few years, I think actually 25, end of 24, 25 should be, we should break out, right? But that's assuming that interest rates will drop and dollar will drop. But if we don't, then sideways, even if we do, we're still maybe a little bit higher, but could have this volatility for the next few years. What strategies work in a sideways market, maybe higher or lower, is being long and short the market at the same time, right? Most, in the past 10 years, if you just buy S&P, you will outperform most money managers or hedge funds. Now, hedge funds, money managers, outperforming S&P. Why? Because most of them have long and short positions, right? The long short equities funds have been doing really well in the past 2 years. Long short equity funds overlaid with options are doing better, right? Outperforming the market, and I think that will continue. So how do you create kind of a balanced fund of both long short? You find the strongest stocks, you buy the strongest stocks, right? Like this week I did Google, right? I bought Google using options. Right, so you're buying Google, right? Because that, you look at the chart pattern, you look at the earnings, and not every stock is the same way, but it's been in strong uptrend, right? It broke through the overhead resistance, looks like it's rolling over, but at least you can see it's been in strong uptrend, right? Google, Meta. But at the same time, I shorted QQQ. Right? A lot of people usually open up a ticket and say, Vlad, you got to make up your mind. How can you be short QQQ and long Google? Well, because I think Google is stronger than QQQ, and I don't really know the next move in the market tomorrow, right? So I want to be long and short at the same time. If I see some reaching some kind of overhead resistance, then potentially I can, make an adjustment. Any questions on the strategy? So again, long and short, being long and short the market, right? You could express your bullish bias, right? If you look at the notes, important notes, if you're new to trading stock or options, right? If you don't know what prospect theory is, right? How the prospect theory works. If you kind of, don't have trading plan, right? This whole concept, which I like to quote now, is think fast, slow. So this book that I've been reading, prospect theory. basically the system one. System one is fast, instant, and emotional, right? We see certain setup, we see certain, people say go buy Meta, we're going and buying, right? Because we heard something on the news, right? Or because it kind of, had good earnings, right? So a lot of our decision, especially when you're new to trading, is kind of in this quick decision, instinctive and emotional, right? As you become more experienced trader, you have to rely more and more on system two, which is slower, more deliberate, more logical, right? Where you have to look at different attributes, right? Author suggests 4 to 6 attributes of the stock market, of the system, and assign values, right? The way I usually do, I look at seasonality, I look at the currency market, I look at the yield market, I look at the chart analysis, right? I mean, and I do look at the earnings, momentum, and consistency, I assign values 0 to 10, and then I add them together, and that's how I decide whether I want to enter the trade or not, right? So if most of your decisions are done in system one, right, I would consider only having 4 positions at a time. If you already and the system two, the only way to think slow, in my mind, I don't know how to think slow unless I write it down. So if you're not keeping journal, if you're not writing, if you don't have a written down trading plan, I propose, which is okay, when I start trading, we all were in the same boat. There's nothing different. Now that I have a little bit more experience and I read these books, I kind of, it helps me analyze my own thinking much better. Then I propose start with only 4 positions at a time, right? What does it say that? All right, so only having 4 active. If you're new to Tradespoon, right, or you kind of rely on system one, you make decisions very quickly. You don't really have a well-defined system two that makes these more, slow decisions. Start with 4 positions and not risk more than 2.5% of account value. And just go through multiple iterations. A Tradespoon will help you by, you can see my orders. I don't hide them. Every day you can actually see exactly what my positions are. Today I trimmed LLY position, right? Actually I closed LLY position. Yesterday I closed Google spread, bullish spread. So it's a combination of both stock and option trades. Yesterday, I shorted QQQ stock, right? I sold Iron Condor and Citigroup. So you have example of both long short stock, long short options, and you have to make a decision on the, some people more experienced, right? They understand what prospect theory is, they understand, how to determine position size. All of these theories to me, and all they basically justifies that in order to be a good trader, you have to be comfortable with your position size. Right. One of the things that prospect theory says, emotions obviously drive our decisions and what the author basically says, you have to be kind of build this immunity to your emotions. Not immunity, you will always, nobody likes losses, but you have to be comfortable is also not the right word, but you have to logically understand that these losses can occur. When they do, it's just one of many trades and you move on. And so the only way to do it is to find the right position size. Yesterday we were having debate whether I should do. Actually, speaking of that, let me just close this because it's been fluctuating. Give me 1 second. Citigroup call. And so when I put a trade, you right away can see it here, right? So I close the Citigroup. So that's very important, right? Very important to kind of understand the position size. And we had discussion yesterday, do I do Citigroup or do I do JP Morgan? Well, they both actually came very close to the range, right? We talked about JP Morgan 152.5 call. So the stock actually was much higher, not much higher, but was then 1% higher than the expected range, right? Citigroup was up as much as 5 to 6%. So if I'm off on 1 or 2% on JP Morgan, well, 2% on JP Morgan, you know, that's $300 if I'm off. But Citigroup, if I'm off by 2%, well, it's $80, right? And everybody reacts differently, right? Someone who has $100,000 and he's down $80 or $300, it might be okay, right? But somebody who has $10,000 or different levels of savings or a different point of their life, the reaction could be completely different, right? That's what this prospect theory talks about, right? We're all of us are different. It's not like I can say, okay, you always do one contract, you always do this, and you always do that. No, we're all different. We all have to find that comfort level, and that takes time and experience, right? And so I avoided Citigroup because I felt like I avoided JP Morgan and in favor of Citigroup because I felt that I'm just taking a lot less risk on one contract. One contract Citigroup, I'm managing $4,000. I can buy stock to defend it. I can adjust. If I'm buying one contract of JP Morgan, that's 15,000, right? And most average account is 10,000, right? So that's where the probability that the emotions are going to get higher, depending on your account size, is very relevant, right? So this is the kind of level of guidance we provide during live trading room. So part of your elite circle, you get access to morning bell and closing bell, and the most important is recording, right? Recordings, I encourage everybody to participate live in the trading room, watch the recordings, right? Because the idea is, a lot of it is repetition. When you think about thinking fast and thinking slow, he discusses Malcolm Gladwell books, right? How to become, experienced in anything, right? It takes 10,000 hours or 7,000 hours. And the author of this book also talks about, if you want to get good in anything, right? In any skill, acquire any skill, it all takes time, right? It's not, nobody can, start trading and make a lot of money. And if they do, right away, right? And if they do, most of the time it's just element of luck, right? Then at some point when the market becomes volatile, you lose money. But as time goes on and you build that confidence and you spend X amount of hours, we're all different, right? This is average. Some people it might take only a couple hundred hours. Some people might take a couple thousand hours to reach that level of expertise, comfort level. But then you still realize that experience is not enough, right? You have to kind of understand how you make a decision and the proper approach. So that elite circle was, these are some of the examples of the trades that you can expect, right, in a live trading room. Any questions? So you can also enter your phone number. You'll get an SMS message every time I trade, and you can participate live in the morning bell and closing bell, which I encourage you to do. And if not, you can watch the recordings. Any questions so far? Bob, thank you. What do you think for trend QQQ from now to January? So we do have different tools, right? So the question, what do I think about trend, right? So Spider's QQQ highly correlated right now, 90% chance, right? So 90%, not chance, 90% correlation between green, which is seasonality, and red and green, which is current price action. So the current price action basically covers exactly what is happening in the market. And if you notice, after, towards the end of October, we started a pretty sharp rally. So on one hand, I still think we're going to have a sharp rebound, right? Sharp rebound. But on the other hand, there doesn't seem like any signs of capitulation, which I spoke for the past 2 years. Still hasn't happened. But we haven't had interest rates at 10-year yield at 5% either, right? So I'm still kind of carefully watching the yield, right? And that's very important for technology stocks, right? If this is the top, then we're very close to the bottom, right? And technology, to answer your question, should rally. Technology should rally. And we had a pretty strong rebound off of the 350, right? Which is, what is it, 62% retracement between the Octobers. Yeah, so all-time high, if you look at all-time high and you look at the October lows of last year, we've retraced 62%, right? That's where the current support is. So if the yield is not going higher, and if the dollar is not going higher, then I think we're very close to the lows, right? Right now we're struggling, we broke through this uptrend, right? We broke through this uptrend to the downside, and now we're trading below this trend line. And so far, technology has a hard time breaking above this trend line. We'll see where we're going to close this week, but it looks like you know, we're still probably going to close right at that trend line. So we're close to the bottom. But again, I think there is a risk, obviously geopolitical risk. I think there is a risk that you know, this higher for longer and stubborn inflation. You know, when Fed, I think the next time Fed talks is first week of November, right? November 1st. So in 2 weeks or 3 weeks, 2.5 weeks, Powell is going to give a speech, and probably he's going to continue to say the same thing, right? That nothing has changed, higher for longer. You know, we might or might not have to continue raising rates. So interest rates will rally again. So my opinion is that, you know, we retest the lows in November, bounce around them, and then we, you know, may or may not revisit the highs, probably below the highs if I have to guess. Right, so first leg down, right? The pattern of higher lows, lower highs and lower lows, I think continues. Right, and then we do have rally, you know, toward maybe middle of December. So Pat, hopefully that answers your question. Kevin, I agree. Geopolitical risk, these are black swan events, right? If you read Black Swan by Talib Hassim, right? Forgot. Nassim Talib, right? A very good book, right? Right, this guy is a superstar. Working in hedge funds. So he talks about geopolitical risk and how easy, you know, you cannot predict. You know, if you read this book, you prescribe to his theory, then, you know, you just can't predict. You can predict that they will happen, but you know, you're going to have a hard time predicting when they will happen, right? So that is obviously a risk, you know, but something to keep in mind. Let's look at QQQ. Fighting for the 50-day moving average. Let's adjust this guy here. So we're fighting for the 50-day moving average and for the important level, right? 50-day moving average and 50% retracement from recent August highs, right? August highs and September lows. If we break below that level, probably three, then there's a chance we might continue to go lower. Thank you, Kevin. That. Okay, Kevin. Thank you, Kevin. Get into stock by selling puts once after they reveal your thoughts. Was looking at a buying 6 to 26 or 624 June 24 butterfly leap that get into stock. But selling puts once in stock, do the wheel your thought. Well, I'm not sure. Yeah, so Pat, butterfly leap. Butterfly leap to me means that it's a three-legged strategy that expires on June 24. Usually butterflies, you don't go that far out, right? Because it's hard to predict where the market is going to be on June 24th, right? Then get into a stock by selling puts. Once in a stock, do the wheel. The selling puts and do the wheel in general, I think cash secure, as long as you do it cash secured put. So my favorite strategy right now, if you have a larger account, I mean, you have to have a lot, every time you say I want sell and put and to get into a stock, you have to be a cash secured put, right? One contract of QQQ, that's $36,000. You have to have a large account, but in general, I do like, if you have a larger account, use either mirrored puts or mirrored calls, right? Or cover calls, cover puts, right? This idea of this way you don't overtrade your account, right? Let's say you're bearish on QQQ, right? Pretty significant sell-off, fighting for 50-day moving average, you're waiting, one more leg down, and it probably makes sense to short QQQ. What sometimes I do, I would sell, mirrored, you have mirrored put, you can have mirrored call, right? You sell short the stock, right? 100 shares, because I think it's heading lower. But what if I'm wrong? If I'm wrong, I'm going to buy a call, right? You buy a call, right? One contract. This way you're protected, right? Let's say next week we have the earnings continue and they're great, right? I don't know, IBM announced earnings, Microsoft announced earnings, and I'm wrong, okay, and you have something like this, then at least you're locked into your losses. You know exactly the maximum loss. But if the stock, it's just like buying a put to, buying insurance, right? You buy insurance on the house, you spend 1 or 2%, okay, this is the cost of doing business. Same thing here. Maybe you give up 1% on this QQQ trade, maybe less than 0.5%, right? But it's okay to give up 1% on QQQ, just to, hedge, because it can go like this or it can go like this, right? Right? You don't know if it's going to be down, 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 or if it's going to be down, up, right? And most of the time, you have reversion to mean. So I'm a big proponent of cover calls, merit puts, right? These market neutral strategies with certain bias, right? And you could do the same thing you can do if you think it's going high, right? That's one idea. You might say, listen, I think Vlad, you're on, it's going higher. Okay, you can buy a stock, right? You buy a stock because, you buy 100 shares because you think 50-day moving average will hold. This 50% retracement will hold, or earnings are going to be better. Okay, then you buy 100 shares and you buy a put, right? You buy this put, one contract. right? At least if you're on and it does break 50-day moving average and continues to reverse, at least you're limited on your losses, right? You don't want to see, $20 drop on 100 shares, $2,000 loss, right? But spending 1%, maybe $4, $400 makes sense. What do I see on Tesla support? Tesla 153, I think you mean 253, 251. I mean, it follows the same thing as QQQ, right? It's a pattern of lower highs. Well, it's a descending triangle, right? It's actually. So yeah, it's a descending triangle, right? With the flat support right here and flat support here, right? You have these two support lines. And it's going into critical junction, right? This is considered to be a bearish price pattern. Then you have earnings in 5 days, right? And then you have an event, right? This is considered to be a bearish price pattern. So I would say 60% of the time or 70% of the time it does this. I would say 65% of the time it does this. 35% of the time, right? If you read Murphy book, right? Another good book to keep in your considered to be kind of a Bible of technical analysis. If you haven't read, John Murphy technical analysis, I encourage you to do that. But anyway, so it's a close to towing costs, right? It's going to be Tesla earnings. On one hand, their margins continue to decrease, and everyone's concerned about that. On the other hand, they're superstars, right? Ford is struggling with all the, strikes and General Motors, and their market share continue to grow, right? And if they say, listen, our market share continues to grow and we are delivering more and more vehicles, okay, then you have pop, right? And then we go back to 300. In general, earnings, you're at the mercy, right? Short term, Tesla is extremely overbought, right? It went from 108 to 300. It tripled in its size, in its value. So they have to deliver good earnings. Anything negative, like their margins are worse than everyone expects, or they're delivering less and less cars every quarter, then it'll be hard to justify, the multiple of 74. Right, or whatever. This is trailing 12 months, but they are trading a high multiple, right? They're trading like they're Nvidia of the world, not like they're Ford of the world. And so I think the risk is to the downside in Tesla in 5 days. Yeah, Pat, if you want to stock at a lower price, I agree. So option wheel is a great strategy. Right, option wheel in general is a great strategy, especially in this sideways market. I don't see a good source. But I mean, you can look it up. But yeah, so selling. But as long as you have a larger portfolio, and instead of buying 100 shares of stock, you buy 100. You sell one contract put. I do like that strategy. but you have to have, larger account, right? That's kind of the most important part. Any other questions? And QQQ continues to deteriorate. Thank you, Pat. Bob, thank you. All right, 1027. So I went over some of the tools we're using at Tradespoon, right? Stock forecast toolbox. I use it a lot for 10-day prediction, 6 months prediction. Seasonality on ETF stocks, you can use that. We do have probability calculator that gives you probability. There's 64% chance based on historical volatility, that we will revisit the highs in the next 50 days, or we'll revisit 404 level, right? Both scenarios are within one standard deviation, right? And if in downward market, maybe 404 is conceivable, right? In upward market, maybe 464, but only 17% chance we're going to drop below 400, right? So we have tools like that. If you want to follow my trades, I encourage you to visit Elite Circle, right? To sign up for Elite Circle, then you'll see both stock and option trades. If you do have a solid trading plan, if you keep in a journal, you understand prospect theory, you've been doing this over and over again, and you're just looking for models, trade ideas, I encourage you to consider active trader, weekly trader, and monthly trader. If you're new to trading and you don't have a trading plan, I would not use these models, because a lot of, one thing that I'm always concerned, we have a new subscribers and say, Vlad, you promised us 10 signals a day, I want 10 trades a day. Like, right away my reaction is, you probably haven't traded long enough to understand that, unless you're a day trader with a lot of experience, you can't manage 10 trades a day. You can't even manage 10 positions a month, let alone, 10 trades a day. So that's to me is like a red signal, right? So that's why, we have different services for different types of traders, but it's not like everybody should have all, some people it's appropriate to have Elite Circle, some people it's appropriate to have active trader, right? These big services are meant for self-directed investors that are confident and they trust the process and they look for AI models to give them signals. Okay, then that's these are services. These portfolios where you can follow my trades. If you're an experienced trader and you just want a second opinion, right? Go into prospect theory. You don't want to have multiple opinions, give them weights, and then make your own decision. And if you want one of the inputs to be my opinion, great. Then Elite Circle, Premium Portfolio. If you want to learn how to trade, I think these are the great tools to learn how to trade or build confidence as you trade. All right, any other questions? All right, it's 10:29. Thank you very much and have a great day.